Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. I'm Eugenia, Head of Sustainable Investing, and on this episode of the podcast, we dive into the topic of climate investing. Joining me today for this conversation, I'm glad to welcome John Cappetta, Head of Private Banking at 91. Climate change issues have increasingly become front and center globally, and 2021 could be a turning point for tackling climate change issues. There have been big supportive trends such as the European Green Deal and a Democratic U.S. President in Joe Biden, who has ambitious plans to fight climate change. Climate investing is also one of our Chief Investment Office themes in 2021. John, from an investing point of view, why is climate change important to investors?
Well, thank you, Eugenia. First of all, just let me say I'm delighted to be here and to be associated with Standard Chartered and to know that we're in line with Chief Investment Officer with regard to climate investing. So to get to your point in terms of why is climate change important to investors, well, from an investment point of view, we believe there are three compelling reasons to allocate to a portfolio of companies that will enable the process of sustainable decarbonization. Those three reasons: number one, the flow of capital into sustainable decarbonization represents a powerful multi-year structural growth driver. Number two, correct the structural underexposure to the enablers and the beneficiaries of decarbonization. And number three, provide a hedge against systematic carbon risk in portfolios. I think that part, number three, is very important because some clients might not realize the potential effect of climate change or decarbonization with some of the existing investments that they might already have.
So definitely something for investors to keep their eye on. So, the question of the hour really, and we've been getting tons of questions on this, is that climate-related investments had a good run building up to the later half of 2020, and it lost quite a bit of steam coming into 2021. Are we in a green bubble, or is this leading up to a green revolution?
That's a question we get pretty consistently these days, and I can totally understand why. You mentioned the run-up in December of last year, and it was extremely strong. We saw a flood of assets just come into green investing, ESG investing. But what we have to sort of take into account when we ask that question, are we in a bubble? Well, first, let's look at the facts for a second. According to the latest Bank of America Global Fund Manager Survey, which was just recently published on April 13th, only a little bit more than 15% of those surveyed believe ESG is a crowded trade. Now, let's put that into comparison of where they see the most crowded trades. Amongst the people surveyed, 32% say long tech is the most crowded trade, followed by long Bitcoin at about 28%. And just to make note of that, long tech has been the most crowded trade, according to Bank of America Fund Manager Survey, for the past several months. So you look at it where ESG investing is 15%, a little bit more than 15% believe we're in a bubble. So, that's not too bad. If it was a significantly higher, I'd have some concerns. What we have seen recently, we have seen much needed pullback in the asset class. Managers were sort of shifting out of some of those names that did extremely well. We have saw some weakness across some of the names in China. Interest rates have moved up, so we saw some pullback in some of the green utilities. But again, for the long-term success in climate change, this is exactly why we would recommend active management over passive management. You want an experienced investment management team that will make these decisions. They'll make these sell decisions or these reduce positions when their names reach their price target. And you want them to be able to shift the portfolio when needed. Not to say that they're going to have a crystal ball and know when to get in and when to get out, but at least you can know that they're watching the portfolio, they have price targets on some of these names, and they will take off when needed, just to sort of rebalance their own portfolio or even exit a position to replace it with something else that might be a little bit more attractive. But I think the key message that we'd like to get across today in this podcast, we want investors to keep their eye on the long-term prize. It's going to be about time in the market and not market timing. The true success to ride this decarbonization wave, this climate change wave, will be patience and time. I truly believe that the next 10 years for climate change investing could be what the tech sector was for the past 10 years. the long-term investment reward is very compelling. But like all market cycles, along the way, we must expect some volatility.
So pivoting from these investment trends through to terminology, we hear many different terms like green, sustainable, and ESG. Let's talk a little bit more about ESG now. Can you first describe ESG to someone who's never heard of that term?
Yeah, I always get a little smile on my face when I hear the words ESG. Those three little letters are causing big impact globally. And frankly, during the past 6 to 12 months, I forget that there are 23 other letters in the alphabet. So ESG. ESG link concepts that underpin so-called responsible or sustainable investing. The E stands for environmental, S stands for social, G stands for governance. Each cover a range of factors that, when considered together, build or paint a picture of an enterprise's credentials regarding sustainability, equality, and corporate fairness. If I had to give it a synopsis in a little bit more in terms of ideas or areas what the three mean, you could look at environmental, and that could be the energy use, waste disposal, carbon emissions. If you look at social, you talk about diversity, opportunities for women, as well as employees' rights. And if you look at governance, that takes into account the composition of boards, some external trustees, as well as voters' rights.
Great, that's really helpful. So now, how does green, sustainable, and ESG relate to each other?
Again, great question. That's why we think it's critical that investment managers or money managers, when it comes to ESG or climate change or green investing, they must have a clear investment process. What an investor should focus on is how an investment manager integrates ESG factors along their entire investment process, from start to finish to ongoing engagement with their companies, from initial screening of their investment universe all the way down to their portfolio construction. If investors are concerned about potential greenwashing, which they should be, they should follow the recommendations of their bank, like Standard Chartered, who performed a deep dive due diligence process to make sure investment solutions are true to label. So now I get to interview you. Let me ask you, Eugenia, how do you think about it over at Standard Chartered?
Well, at Standard Chartered Wealth Management, we define sustainable investing as investing in solutions that not only gives us a financial return, but also generates social and environmental benefits. So if you're interested in sustainable investing, there are a few approaches to explore, and they're not mutually exclusive. For instance, there is exclusionary screening, where clients can avoid companies that do not align with their values, such as tobacco producers or alcohol. That's perhaps most commonly associated with sustainable investing. But there is also ESG integration, where environmental, social, and governance factors are looked at in addition to traditional financial analysis. There is also sustainable thematic investing, which focuses on one or more sustainability issues like climate change, clean water, or education. And lastly, in impact investing, the primary focus is on the intended positive environmental and social outcomes.
And just let me add before you go to closing, from 91, with regards to our feedback to Standard Chartered, we were extremely impressed with the team with regards to what you're doing on the ESG side of due diligence, as well as what your product team is doing with regards to just the overall due diligence of the product. Fantastic organization, really deep dive, and it gives us comfort knowing that you're going to show potential products to clients who went through a deep dive process, and you're trying to avoid those areas of greenwashing. So well done to you.
Great. Thanks, John. It's been a real pleasure working with you guys as well. So we've covered quite a bit of ground, and I hope that we have helped everyone get to the core of climate investing. Thank you, John, once again for your time, and to everyone for tuning in. That's all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Market Insights. As a reminder, if you've enjoyed our discussion, please rate and review us wherever you get your podcasts. Thank you once again for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.